One of my favorite strategies in the market is to invest in what I would call a mega trend. Mega trend is something like AI, something like robotics, something like automation, something that's really impacting our daily lives. And I believe there's a mega trend. It's been gaining some popularity recently. It's not popular enough. It's not talked about enough. And it's mainly the whole idea of deglobalization, national security concerns, reshoring, anything that's domestic, anything that's critical to national security and infrastructure in general has started to gain some momentum. We saw what happened to the defense stocks. We saw what happened to a lot of companies that the government invested in them. They did really, really well. Intel and many others. So I have two stocks to bet on the whole reshoring mega trend that I believe is unpopular. And those two stocks are unpopular. They're not talked about a lot on YouTube, and I do own them. They're finally going down. So I want to talk about them again. And I really hope you enjoy it. Now, the first one is mainly around power and electricity. Electricity prices have been rising like never before, not just due to a lot of consumption from on a regular basis, but it's also due to AI data centers that are consuming massive amounts of energy. And we have an old grid in the United States, but electricity prices have been surging. I don't think that's going to stop anytime soon. And the stock that I have today is my beloved Constellation Energy, ticker symbol CEG. The stock is finally going down, so that's why I'm talking about it. It's down 9.5% over the last 5 days. Constellation Energy is a utility company. It's more of a private utility company, so they don't adhere to price controls from the government. They can pretty much set their own prices based on supply and demand. They have a massive nuclear fleet. This nuclear fleet is capable of powering 27 million homes in the United States, or about 10% of the nation's clean energy comes from Constellation Energy. And they don't just power, homes and households in general. They also power the government. They have $1 billion contract with the government to power 13 government agencies under a 10-year contract. And due to the massive consumption from data centers, a lot of companies like Meta, Microsoft, and others have been desperate to secure power and mainly electricity for the very long term, which is why Meta has signed a 20-year deal with Constellation Energy for Constellation to power their data centers for the next 20 years. That provides a lot of visibility. And same thing with Microsoft. They signed a deal with Constellation Energy to also power their data centers for the next 20 years. And there was an old idled plant, which is called the 3 Mile Island plant, nuclear plant. It's pretty much been idled for many, many years. Now they're bringing it back online just to power Constellation Energy's Microsoft deal. There's many of those kind of plants that are idled, and they could restart them and then bring in massive revenues for Constellation Energy. But the best part about the business, my favorite part, is how much the visibility they have. And the company has visibility of 13% earnings per share growth minimum from now to 2030 and even up to 2032. And this is due to the government's tax credits back in 2022, and it was a bipartisan deal. They gave a lot of nuclear companies tax credits, which puts in a floor, a minimum on how much they can charge for electricity. Now, there's no ceiling. They can charge as much as they want based on demand. CEG has been able to do that. But the credits, which are inflation adjusted, they give them a minimum of 13% earnings per share growth to 2030 and even up to 2032 to encourage a lot of those companies to bring back a lot of nuclear fleets online to help power the United States. And that's not going to change anytime soon. So this is a massive, massive deal, and it's a massive mega trend in general. Now, the biggest problem with a lot of the nuclear-related stocks and nuclear power is the number of refueling outages. So they do have some outages every 2 to 3 years. This year they had 12 outages. Next year they expect 15 refueling outages. And that's not really good for the company. It temporarily slows down the growth, you could say, which is why the company has acquired another utility company called Calpine. And Calpine and Constellation, as the deal is done, it's now the largest utility company in the United States. It's not even close. And Calpine has a natural gas fleet. So the natural gas fleet compensates for the nuclear energy outages whenever they have the outages, and they complement each other. The deal is very accretive, and it was a very successful deal, in my opinion. Now, for their guidance and the company's outlook, they're seeing, as I told you, at least 13% between 2024 and 2030. Now, on top of the base earnings, they have something called enhanced earnings. Enhanced earnings is whenever they can sell electricity or power in general above the floor of 13% based on supply and demand, and they have done it many times. Now, the enhanced earnings will provide them 20 to 25% on top of the base earnings. And on top of the enhanced earnings, they have the Calpine acquisition, which should provide them at least $2 of earnings per share for the very long term. And that's really, really amazing. Now, for my upside potential, I took in the guidance of $9.70. I added $2. This is $11.70 for 2026. Okay, I put in $11.70 for the next 4 years to get a 2030 5-year total price target and 20% earnings per share growth. I think they could easily do 20% with the new acquisitions, 13% based, 20 to 25% on top of the base. In total, that would be $24.26 of earnings per share. Not bad at all. Now, looking at the multiple, it's a little bit extended. It's trading at 29 times forward earnings. And to be honest, I would not be surprised if they sustain the multiple after the acquisition and after a lot of people and investors have realized how critical Constellation Energy is to the grid and to power all those data centers, the government, and many different things, and this is a trend currently. I would not be surprised if they sustain it. But in case they don't sustain it, we're going to take a margin of safety and we're going to use 23 times forward earnings as our base case. Okay, so we take in the $24.26, 26, and I time it by 23 times earnings, again, as a base case scenario. That's $557 per share. If I want to get it double over the next 5 years, or at least 15% annual return for the next 5 years, I would have to buy CEG around $278, or you could say around $280 per share. The stock right now is trading around $324, and it's been coming down. So I don't believe really the stock is too expensive over here. If it sustains 25, 27 times, it's a double over the next 5 years from today. But if you want to get a margin of safety around 280 to 275, it looks really, really interesting. I think that would likely be an amazing entry on the stock if it ever gets there. And that's my opinion on Constellation Energy. And I bought the stock back in 2024 around $156, and I've had many drawdowns. So if you're buying it, you're going to have to be okay with a potential 22% pullback, 53%, 20%. It's a utility company, but really trades like a meme coin, which is really funny to me. And if you want to learn a little bit more about what I do and know when I'm buying something, when I'm selling something like Constellation Energy, I share everything I do in my group, and this is the link if you're interested. Now, the second one, which I want to talk about it again, it's been having a great year so far, and this one has 10 to 20x on the upside, and this is Ouster. Ouster stock has been doing well so far. It's up 19% year to date, but I think it's only getting started. Ouster is mainly a LiDAR sensor related company, and I'm going to tell you how that relates to the mega trend of national security. But LiDAR sensors are pretty much everywhere. They would call them the eyes of AI. So if you want to bring AI and automation to life, to robotics, to industrial applications, you need sensors to be able to see where the robot is going and to be able to sense in general. And this is what the company does. So they pretty much sell shovels in the gold rush, and that's what the company is doing. Now, this is an example with Serve Robotics. If you've seen those delivery robots from Serve Robotics, they have LiDAR sensors, Ouster LiDAR sensors. It's the largest, one of the largest customers for the company, and this is a $14 billion TAM. Then they have industrial. Industrial is huge for them. So any kind of automation, even Amazon uses Ouster in a lot of their robots. I could show you the pictures, and it's been doing really well for the company. This is an $18 billion TAM, and it's a massive TAM in terms of warehouse automation, agriculture, mining, construction, and a lot of different areas. Then they have my favorite part, which is smart infrastructure. Smart infrastructure is pretty much traffic monitoring sensors, traffic monitoring systems for a lot of cities in the United States. Now, my favorite part about it is they don't only sell the hardware that that a lot of those cities need to monitor the traffic, but they also sell a software system alongside the hardware. And if you're buying the hardware, you have to buy the software. So the company is building a recurring revenue, high margin recurring revenue business model that's not just based on hardware that you have to keep buying, but software, which is pretty much recurring revenue, high margin. And over the long term, the software potential of the company is likely going to be huge. And I really like this part of it, that it's not just hardware, and they're also focused on software. Now, the last market for Ouster is automotive, and they're not really big in automotive. This is the most competitive area of, you could say, LiDAR sensors. There's not much competition in industrial. There's not much competition in robotics, but there's a lot of competition in automation, especially from Hesai and a lot of the Chinese-related cheap LiDAR players. And that's the biggest concern on the company, was the cheap Chinese manufacturer of LiDAR sensors. But very recently, the US government had a lawsuit around the, Hesai, and Hesai lost the lawsuit, and they blacklisted Hesai from the United States in terms of operating in national security related areas. So it cannot be used in autonomous drones in defense applications. Ouster is the only LiDAR company that's approved to be used in defense applications, and they have customers like Anduril drones, autonomous drones. They use Ouster LiDAR sensors. Shield.AI, Skydio, they all use Ouster LiDAR sensors, and they have to, because it's the only one that's approved. But the United States has pretty much banned Chinese LiDAR from national security related industries. And very recently, there was a bill that was introduced. It hasn't been voted on yet, but it was introduced, and it's a bipartisan bill from a Democratic senator, which to me is interesting. And he wants to phase out Chinese-made sensors, LiDAR, and self-driving cars and critical infrastructure amid warnings they could be hacked and disabled from space during a conflict, crippling vast US systems within seconds. So this is the mega trend that I was talking about, where Ouster is the only one that's made in USA, and it has the certification for defense applications. And the biggest competitor was the Chinese LiDAR. Chinese LiDAR was banned from competing in a lot of the traffic monitoring systems and national security stuff, defense, where Ouster operates. But then they also have competition in automotive and other areas, and now they're trying to phase them out there as well, due to, again, reshoring, national security concern, critical infrastructure. And Ouster is one of the last companies in town. It's the biggest US manufacturer of LiDAR. And if that does pass, this is extremely bullish for the company. So the company is sitting on a major mega trend, not just from national security concerns, but also automation, a lot of reshoring that's happening, manufacturing in the United States. We also have some immigration laws that's deporting a lot of people, and that's not too good. But we need cheaper labor in the United States, and that's why we have a lot of automation, and that's why Amazon is using Ouster LiDAR sensors. So the company is sitting on a major mega trend, and it's speculative, but if I'm right on this investment, it's the upside is really going to be crazy. But the company, has been doing really well. Quarterly revenues have increased a lot. Every single quarter, pretty much, they increased in revenues. Gross margins is about 40%. So if there was so much competition around Ouster in defense applications, in industrial, and also in robotics, they would have like 5, 10, 15% gross margins. But the fact that they have 40% is for a reason. And I think this is because the company specializes in industrial, it specializes in robotics, and not so much in automotive, where you have lower margins like Luminar, which went bankrupt. Now the company is unprofitable, but it has been improving in terms of losses, from losing 95 cents, so sequentially it's been improving. Now it's losing 37 cents, and it's expected to be profitable by Q1 of 2027. And another concern with the company is the fact that they dilute so much. So there's a lot of dilution within the company. They dilute stock. And the main reason they did that is because they were unprofitable. They're going to turn profitable. And the second reason the company has highlighted is they're trying to have a good balance sheet, for them to show Amazon, to show their customers that they're not going to end up like Luminar Technologies, which is a popular LiDAR stock, and the stock is going to zero. It's pretty much filed for bankruptcy. They don't want to be like Luminar. They want to show them that they're financially stable and they can be a trusted partner, which is why they had to dilute stock, build up 240 million in cash and zero debt. So that's going to ultimately improve over time, especially as the company becomes profitable. And I'm very optimistic that that will be the case. Now, for the company's guidance, they're guiding 30 to 50% annual revenue growth from now to pretty much as long as they can see. And I think that's really achievable, as the company is barely making 140 million in revenue. And I just told you all the trends they're riding in terms of automation, national security, defense, and 30 to 50% on 140 million. I think that's really sustainable for the next 5 years, if not even for the next 10 years. So this is my valuation model on Ouster. I took in the current revenue of 150 million for 2025 for the next 10 years, because this is a long-term speculative investment for me, and 35% revenue growth. I think that's going to be achievable. We get $3 billion of total revenues over the next 10 years. We take the $3 billion. I'm going to use two different estimates, 5 times sales and 10 times sales. Now, using 5 times sales, which is lower than where Ouster is trading at, I get a $15 billion enterprise value kind of estimate. The current enterprise value is $1.3 billion. So if we divide it by $1.3 billion, I get about a 10.5x, a 10x, or around 1,000% over the next 5 years. Over the next 10 years with an amazing company like Ouster. And of course, if it trades at 10 times sales, which I would not be surprised, why not? It could be at 19, 20, 21x over the next 10 years. But the company, of course, is speculative. It's still unprofitable. So that's why it's a small percentage of my portfolio. So if I'm right, the stock goes up 10, 20 times, I make a lot of money. If I'm wrong and the stock goes to zero or something goes wrong, then I don't really lose too much and I just move on to another one. And I talk a lot about those stocks in my own group, and I tend to buy one of those stocks every year. One of them before was Hims when it was unprofitable at $7, and I bought Mama, which went up 650%. There's many others, and I share all of them there if you're interested. But thank you again for watching. It was not financial advice. Hope you enjoyed it. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.